So welcome everyone. People are starting to come in. 3 attendees so far. We wait just a few minutes until it levels off, or not a few minutes, but a few seconds. So good afternoon, everyone. I'm Tara Brown. I'm interim director at Western Women's Business Center. We're so glad that you're here today for our presentation on cash flow. We also have Dwayne Adams here who, Dwayne, do you want to introduce yourself?
Yes, I'm Dwayne Adams, Associate Director of the Small Business Center at Asheville Buncombe Technical Community College. So happy to be here. I'm here to learn today, just like everybody else.
Great. And we also have with us Laura Ford, who is our client intake specialist at Western Women's Business Center.
Hi, everybody. She said I'm Laura Ford. I'm here. I'm excited to hear Laura's presentation.
Yes.
That makes one of you.
Hey, it makes two.
There you go. Now you're on the spot.
Tara said no comment.
I'm going to hand it over to our main presenter, the other Laura, in just a minute. But Laura, do you want to start with the slides on Western Women's Business Center? And I can just talk about what we do a little bit. So this webinar today is being presented by Western Women's Business Center. We serve 25 counties of Western North Carolina.
Whoops.
That's fine. I know this. We serve the 25 counties of Western North Carolina through one-on-one coaching, workshops and training like we have today, and access to capital. So we are a program of Carolina Small Business Development Fund. So we offer access to small business loans and some of the disaster funding that's available right now. If your business is impacted by COVID-19, we have funding available. In her presentation, Laura is going to talk about cash flow in terms of how it relates to applying for funding. So if that's something that you're interested in, we can follow up with you one-on-one. You can come for an intake with Laura Ford and talk about where you are with your business, and we can help you with that in a more detailed way. I'll just give a little bit of our impact so you know that we are good at what we do, and we've helped tons of businesses in our area. So we have educated over 4,000 clients through group workshops and trainings like this and networking activities. We've supported over 600 businesses through one-on-one coaching, and we're happy to do that even remotely now. So we're talking to people on the phone. We're talking to people over Zoom like we are presenting today. And we may at some point be doing maybe some one-on-one in-person distance, but we can figure that out on a case-by-case basis. And in terms of loans, we've helped 119 businesses get loans through our host organization for a total of $10 million, over $10 million. And all of that has led to businesses creating or retaining over 300 jobs in our area. So we are here to help you start, help you grow, provide trainings on topics that you need, like the ones today. We also have a ton of trainings coming up. We have one tomorrow on customer service. Next week, we have a couple on marketing. So just check our calendar. Most of them are also posted through AB Tech, and make sure that you're taking advantage of all of the programming that we have to offer. And with that, I will hand it over to our new program consultant, Laura, who's going to lead us through our cash flow training today.
Thank you very much, Tara. I appreciate it. And yeah, my name's Laura Wagenknecht, the tough last name, and it's a fun one, but my husband's from Germany, and so there you go.
I forgot to do one thing. If people want to use the chat today, I forgot to do the tech check. So if you want to put in the chat what your business is, so we can get to know each other. If you put, when you go to the chat function, if you select all panelists and attendees, then we can all see you, everyone that's in the room and everyone that's on the panel. So please go in there, put your business, let us know what questions you have. And now I will really hand it over to Laura.
That's fine. Thanks so much, Tara. I did want to say the first thing that I want you to do, because I know you're just thrilled to be listening to a webinar on cash. and like reporting and documents and all that stuff. It sounds like a very boring topic, but I'm happy to say that there are some good things to it. So the first thing I want you to do, though, before we even tackle anything, is I want you to tell me, in the year 2021, I want you to write this down, the amount that you want to earn for the entire year of 2021, not counting expenses, not counting anything, just the gross income, all of your money, just all of it put in there. How much money do you want to earn? How much money do you want to get? So just write that number down. And then what we're going to be talking about today is, what is cash flow? We're going to talk about what the main financial statements are, why all of this is important, and then how to create a cash flow statement. So we're going to start out with, what is cash? People think that they know what cash is. Let me tell you, we don't actually, because people make an assumption that cash is just that hard cash. The reality is cash can include things like treasury bills, investment funds, foreign currency that you might have on hand. It might include checking account and free savings account. So if you get a checking account, it gains interest, that's extra cash that you get. So it isn't cash that you've earned, it's cash that ends up in your pocket. And so those are types of things that I wanted to think about. But in business, cash is the lifeblood. And if a business is running out of cash, it has a heart attack, right? And so your job is to make sure that your business has plenty of lifeblood, plenty of blood running through it, to make sure that you don't have a heart attack. And so there are two rules that you need to remember about this. And the first one is that profitability and cash flow are not the same thing. Sometimes we earn more than what we're going to actually report. Well, no, we're going to report both. I apologize. But you're going to have differences in the reporting forms that you use. And then most businesses fail, and this is a key one, a majority of businesses fail because they run out of cash before they become visible. And it's just stunning to me. But 50% of businesses fail before they even start. So it's kind of important to keep that in mind. And ultimately, cash flow is money coming in. It's what you've earned versus what you spend. So you have money coming in, you earn it, you might hold some, you have to spend some, and then you have money going out. It's as simple as that. That's the flow of cash. But ultimately, it's important to think about projecting and preparing and considering what we're going to have as a budget. Why are we budgeting our money? We need to anticipate what we have in our cash flow, what money we will have coming in, what money we have going out, both the past numbers that have actually happened, the current numbers that have actually happened, and the future numbers that we're anticipating will happen. And these are typically put on a spreadsheet, and we use those to calculate what's happening and what has happened and what will happen. So the cash flow statement itself is just a statement. It's a financial statement, and it shows how much money you have coming in and how much you have going out. But as I said, cash is a little different than money, in the sense that cash is what we're earning and what we're spending. But sometimes we spend it on things that are physical property. And so that becomes, let's say you're a business like a pizza shop. That pizza shop is going to have to buy an oven. So the purchase of the oven becomes a physical item, what we call an asset. And that asset doesn't have a monetary value, but it does on a spreadsheet. It doesn't necessarily equate to cash, because you can't exactly sell that. So, or you can't sell it. You can't exactly, hand over the oven as cash. So, but it's going to provide a snapshot for 12, 18, or 24 months. It depends on your own business and how you plan on doing it, what you plan on doing. and how you plan on approaching your business. So those are kinds of important things. So where does cash flow fit in? You've heard of bookkeeping, and bookkeeping is specifically the recording of financial transactions and is part of the process of accounting in business. Transactions include purchases, sales, receipts, and payments by an individual person or an organization. And then what you end up is through this record keeping of all of those transactions, you come up with income statements, profit and loss, which is really a profit and loss statement, balance sheets, and cash flow statements. And so what we'll see here is that these are the three key financial statements that you have to have in every business: a balance sheet, an income statement, and a statement of cash flows. And as you can see, they all capture slightly different information, but in such a way that you're able to understand your business better. And more importantly, outside people are able to understand your business better. And so this classification of cash flow, we can talk about in a minute, but basically it gives you an idea that the cash flow statement itself is going to look at three activities: operating, investing, and financial. But first, let's start with the income statement. And the reason I just want to talk about this briefly is it gives you a sense of what information is captured by each document. So the income statement provides information about cash flow itself: what money's coming in, what money's going out. That's pretty much what it does. It doesn't capture a whole lot more. And that's as simple as that. Doesn't matter what the document is showing right here. This is just an idea: revenue, expenses, and then you have net income. That's it. The balance sheet is going to look at your assets. Remember, I was talking about that physical item that you might own, equipment that you might own. You might have a car that you own for the business that delivers food or things like that. So those are considered assets. So it's going to include assets. It's going to include liabilities. Maybe you have a loan that you are paying off. That might be considered a liability. And so you have an accounts payable. Maybe you owe on this wonderful pizza oven that you bought, but you didn't buy the whole thing. Like a car, you're paying a loan to keep that asset on your books, but in general, you're still paying on the loan to pay off that piece of equipment. So this document not only focuses on its income, its net income, and things of that nature, it also looks at what did you invest? What are the investments of the organizations? What are the liabilities of the organization, or assets and liabilities? And then what is the equity that's in the organization? And that can be through stocks and things like that, which have nothing to do with most small businesses, but will potentially be critical as the business grows. So thinking about, one thing you can think about is, let's say you have you know how there's Venture Asheville might be people who put money towards the business that you're trying to start. Venture Asheville will put money into it. They're considered, in a sense, a stockholder or an owner, part owner. Maybe a silent partner to some degree. It might be considered a loan, but they might be giving money over too. So it's kind of important that we look at, how is that money coming in? Is it being loaned to us? Are they getting a percentage of the business back because of it? All that stuff. So, but the balance sheet shows this. So you have the income statement, which is cash in, cash out. You have the balance sheet, which shows all the assets. And then you have what is a cash flow statement. And the cash flow statement is really a combination of the income statement and the balance sheet. If you'll notice at the bottom, it says income statement plus balance sheet equals cash flow statement. It's partitioned in different way, but it captures ultimately all of the business flow. And so that's why it's such a critical statement, because outside funding sources need to see this in order to better understand your business. and get a better picture. And so here's an example of a cash flow statement that you might see, and you'll see that it includes net income. It includes depreciation. So you have an asset, let's say that oven, that pizza oven that you bought. Each year that pizza oven is in operation, it loses value. And so that's what we call depreciation. It starts to depreciate with that value. Maybe you bought it for $20,000 and now it's depreciating each year. It's kind of like when you buy a car and the minute you drive it off the lot, it's lost 10% of its value. From the moment you purchased it to the moment you drove it off the lot, you've already lost a percentage of the car and its value because you can't sell it for the same price you bought it for. And then there's a cash flow statement will provide information regarding the liquidity of a business. Basically, a cash flow statement, ultimately, if we're looking at it, is letting us know where the money comes from and how we're spending that money. That's pretty much what it's doing throughout its life course. If you have questions about any of these things, feel free to ask. I'm trying to go somewhat quickly because I don't want to be spending too much time on particular items there. But why does it matter? So it does matter if you help plan. It helps you to plan for fluctuation in income expenses. So let's say you have a course of a year. If you have a pizza place, you know that normally during the football season, you're going to have prices. You can have your prices pretty good, pretty high, and you can make income because a lot of folks are having pizza parties with the gatherings for the football season. This is an odd one. This is going to be an odd year, and there may be some difficulty. So, but in general, you can plan on a spike that in the winter time, most pizza delivery businesses in particular, will do better in the fall season and in the winter because people don't want to drive, they prefer delivery, all those things. So pizza delivery does better. As a result, you can look at those months from, let's say, October through January that are going to go up, while the other months you might have lower sales. And so that's kind of what I'm talking about for planning. Then you can also notice, so you can notice patterns, and then you can make sure that you have enough income to cover your bills. That's a biggie. And why does it matter? Again, it's if you're running short on cash, it's one of the biggest reasons, I cannot stress this enough, that a business closes before it's really even gotten off the ground. And when you revisit this, every time you revisit it, it can tell you where you are in the status of your success. Are you progressing? Are you not progressing? If you're progressing, some businesses might take 2 to 4 years before they see that a profit, right? So what does that mean? Can you plan on that 2 to 4 years? Some businesses, they can start right off the ground and make money right away. But they need to then look back and say, how can I make more money? How can I anticipate making more money? What do I need to do differently to increase my revenue and increase my money coming in? And why does it matter externally? So ultimately, it matters most for the people that you want to get money from. So if you have a great cash flow management system, or your ability to demonstrate via your balance sheet and your income statement and your cash flow statements that you have money coming in, you're more viable, then more banks and other sources of income are willing to provide you with loans. So because it demonstrates that you can pay off the loan. It demonstrates that you can convert that revenue or cash into something that's viable and sustaining. And so that's part of that whole picture that you're trying to build. And what is a cash flow statement? As I said, it's that combination of income statement and balance sheet, but it's presented differently so that a bank can better understand what money is really coming in, what it's being used for, what money's going out, and how it's going out and how fast it's going out, and then looks at what areas can be built higher, such as investing the money. So when we're looking at the operating activities, and if you'll notice here in the bottom left-hand corner, there's operating activities. So if we're looking at the operating activities, we're looking at the cash received from the customers through sale of goods or services performed. We're looking at cash received from non-operating activities, such as dividends from investments, interest revenue. We're looking at cash payments to suppliers or employees. If you have 15 employees, they're part of your operating, they're part of your payroll. So you're looking at then paying their taxes, their employee taxes, and that gets included in the operating expenses. You're thinking about rent, you're thinking about utilities, that's what's in operations. And the reason that I have this thing down here is that the income statement is changed from accrual basis to cash basis via this cash flow statement. And so basically what I mean by this, accrual is if somebody owes you money, let's say you had a transaction and somebody bought a pizza from you, it didn't go through on their credit card, so they still owe you money. It's 20 bucks, they owe you $20. If you're capturing your information on a cash basis just through this cash flow system, you would not capture that money coming in because it's not looking at accounts receivable in that sense. The income statement does look at accounts receivable, meaning money that's still owed to you. So not cash received at that transaction moment. So that's kind of important. The cash flow statement also looks at investment activities. And these are things like if you're going to try and get a piece of property, other tangible assets like the equipment I was talking about, or the car, things like that, then they're going to look at it's going to include those particular items of investments that you've made for the business. And then you're going to have some loans that you might have extended to other companies, and it's going to capture when those loans are due to you, when those loans are going to be paid back to you. So it will capture those. It's also going to capture financing activities. And these are things like you've received cash from issuing share capital, or something more simple is you're getting cash from bonds, loans, notes, mortgages. So let's say you own apartment complexes or an apartment complex, you're getting rent every month from your tenants. So it's going to capture the financing activities that's allowing you to get cash from that. It's going to also focus on cash repayment of loans and other borrowings. Cash payments to shareholders as dividends. Again, this is if you have a larger business and a business where somebody has gone in on the business with you, and they're trying to it will help capture that information as well. So how do you prepare a cash flow statement? Well, let's talk about what's in it and things of that nature. But let's start with, the fact that you probably should not be doing, well, I can't say you should not, but hopefully you're using a program of some kind that would enable you to spit it out through that bookkeeping that I talked about, all of your transactions that you're entering into a system. And then it would provide you with that. But if not, you could prepare your own, or you can reach out to others. The Western Women's Business Center is a great opportunity for you to look at having them help you with this process. And specifically, it's going to ask you, if you're going to be looking for a loan or things like that, at minimum 2 consecutive balance sheets and income statements that covers those 2 balance sheets. So the time frame for a balance sheet usually is a year, and so you want to make sure that you have at least 2 years of information. On the other hand, if you're just starting a business, you need to prepare what you think will happen in 2 years. And so that's budgeting and projecting out what you think will happen. So the Western Women's Business Center can definitely help you with that. And I really encourage you to utilize that service if you can. The cash flow statement, this looks complicated, but it's not. So the top left-hand corner says name of the company, and it's a cash flow statement. It's telling you what's the type of document for the period of, and it can tell you from January 1st to December 31st. Some businesses operate on what we call a fiscal year, though, and that fiscal year might be, say, June or July 1 through June 30th, or it might be October 1 through September 30th. And so it depends on when you have the flow of your business. So it may not be a calendar year, it might be what we call a fiscal year. But basically the cash flow statement includes those 3 items I talked about: the operating activities, the investing activities, and the financial activities. And then ultimately you end up with a net change in cash, and that's what it's going to show. Now, I'm going to take a pause. Tara, do we have any questions? Does anybody have any questions that they want to ask me right now?
We don't have any in the chat, but feel free to put your questions in the chat. And if you're having trouble using the chat, I believe you can also raise your hand and we can allow you to speak.
I know I've gone pretty quickly through some of that stuff, but I wanted to, I don't know. Tara, can you give me some feedback as to whether that what I've said so far is making sense? Is it flowing with the use of information I've provided so far?
Yeah, thanks so much for asking. I think the next slides and the concrete examples might help. It might also just be helpful to know people in the room if you're totally new to this and this is the first time you're thinking about documenting this, or if you've already been working on it, that would be helpful just to get some feedback from people in the room.
Yeah. Thanks, Tara. Yeah, I'm thinking about, money and forms and income and revenue and expenses, money going out, all that stuff can be quite intimidating. And I think, for myself, when I have to deal with accounting, it kind of goes, oh, but on the other hand, the more I know, the more prepared I am to have conversations with people on different levels and hopefully be able to better assist them that way. Some of the key terms that we need to think about, I've sort of already said some of these, but I think it's important that as we go forward, we need to think about cash on hand, which is sort of obvious. It's how much does the business have right now, cash going out, what's leaving the business, what's coming in, and then ending cash or ending cash balance is, how much do I have left over based on what went out and what came in. And ultimately, though, we need to start thinking about how are we going to price items that we might be selling, or how much are we going to have to earn to actually make a profit. And so break-even volume looks at how much money do we have coming in, or first of all, let me think of it this way. How much money is it going to cost us to produce an item? And we're not just looking at, let's say, the pizza. We think about, we're just going to make it simple again about the pizza. So when we think about a pizza, we think about the cost of having to have the tray. So we had to buy the tray that's going to go into the oven. We had to buy the dough and make the dough. We have to buy all of the things that are going to go on the dough, like the tomato sauce, the cheese, the pepperoni, whatever you want on there. For you veggie lovers, maybe some peppers and onions. And then we're going to talk about it goes into the oven. Well, how is it going into the oven? Are you placing it there, or have you know how sometimes there's a brick oven and you have one of those big trays, those wooden trays that can slide it in. So you're going to have to purchase those. Then there's the purchase of, once you've pulled it out, you have to have the cutting item and the slicing item. And then you have to have a box to put it in so that you can hand it to the consumer. And then are you going to have receipts for people? So now you have paper that you're going to have to provide them. There may be a bag that you need to purchase to put that item in. There are any number of things we have to think about when we think about the cost. And I haven't even talked about the rent on the space that you're using, the utilities that you're spending to keep the place lit and open. Maybe you have to have a security system, so you have that purchase item that is happening. Every month you have a water bill because now you have to clean all of the utensils and everything that you're using. You might need a mop and a bucket. You get the sense of what I'm talking about. Is all of these different items are involved and included in that cost. And once that is developed, you then can think of, and here's the kicker because I forgot one of the biggies, your salary. That needs to be included. Your employees' salaries, that needs to be included. And then you can think about, if I take all of those costs, how much is that going to cost me to make a pizza, a single pizza? And then how much more do I have to earn to make a profit? So when we think about pizzas, I would imagine that the break-even price is probably, $4, let's say, and they're selling it for $5.99. But that's based on volume too. If they have a high amount of volume, then they can afford to reduce the price. If you have a lower volume, you're going to have to increase the price to break even. And then there's a unit sale price, and the unit sale price is basically a unit is what you're selling. It's that item, a unit of what you're selling. If you're a service organization and you're a consultant, then the unit is going to be the item that you're selling. Might be like a workshop. The unit you might be selling might be an hour of your time. So units can be products or services. And then the unit cost is what it costs you to keep your service going, the very basic. And then there are fixed costs versus variable costs. And fixed costs means that things like rent are going to be the same pretty much every month until you have an increase in your lease for the rent, right? So your fixed costs is what you're going to be spending every month. But let's say you have utilities. Unless you're paying a monthly fee consistently every month, you're going to have fluctuations based on weather, right? So right now it's very hot. You're going to have a high air conditioning bill, so it's not going to be a fixed cost. So it would be considered a variable cost. Those are the types of things we want to think about when we're thinking about those terms.
Laura, we do have a question and a comment now, and I was typing a response in the chat. So Robin says this is fairly new to her and she's still trying to get a budget filled out. Does Western Women's Business Center have budget forms with lots of different categories for small business? Since she hasn't really brought any cash in, she hasn't felt like she needed to do this yet.
Do you want to go ahead and answer that, Tara?
Sure. So I will send it in the chat too because I already typed it out. But I will just say I'll turn my video on also. So hi Robin, good to see you on here. So we do have a cash flow Excel sheet that we will send out after this presentation. We also have in our business plan template some more simple tips on making a financial plan. So they start with things like making a list of all the things that you need to buy for your business. Mm-hmm. Make a list of all the things you need to run your business. So I know Robin does a consulting training type business, right? So you need to have a computer, you might need to have some software like Zoom, for example, $15 or yeah, $15 a month. If
Paper, printer.
paper, yes.
Yeah,
You've
definitely.
traveled anywhere for those trainings. I know I've done some trainings as a consultant, and I have a whole closet full of post-it notes and markers and all of that. It was like $100. So you might think, well, I haven't really, brought in much income yet, but it's important to document all those costs to make sure that you're making up for it in income.
Yeah, that's great. Thank you so much, Tara. I appreciate that. And thank you for the question, Robin. Wonderful. So let's look at our cash flow statement and look at basically what we're going to look at, answering Robin's questions. I know that I started sort of high level, and now I'm weeding it down to saying basically, how are you going to develop this document if you develop this document? You're going to come up with sales and business income. You're going to have how much are you need to include how much you're expecting to be coming in on a monthly basis. And looking at a month is a good snapshot each time because it's easily defined. A quarter is helpful to understand the progress that you're making, but looking at weekly or monthly information is really the way to go. And then looking at quarterly and annually how you've done is advantageous over the year to look back and determine what needs to change and what needs to improve. And how much will change month to month. Unless you've had a business open for a while, it's difficult to figure out what's going to change month to month. On the other hand, let's say you lease a space, and that space for the first 12 months has a certain rate, but then may ask for a higher rate the following 12 months. So let's say a company said to you, I want to go ahead and support your business venture, so I'm going to start you at a lower amount, but then I'm going to build. Because as you make more money, then I want to start making more on that rental space. So some companies that own property might say, I'll give you a lease at this rate for the first 12 months, this rate at the next 12, and that kind of a thing. So knowing how much will change month to month, that might be anticipated. On the other hand, let's say you have a 12-month lease at a spot, and when you go to renew it, it suddenly goes up. While you know the net amount for the next 12 months, you may not have had time to budget that into your projected budget for the next year. So that's what is kind of difficult to think about. But basically, you're trying to figure out ahead of time, what do you think it's going to cost you to run your business month to month? And then will you get paid for your sales right away? Right at the time of transaction, like I'm going to buy that piece of pizza, I'm the consumer, I'm buying that piece of pizza, here's your money. That's the transaction, getting money right away. Or are you going to sell something, let's say like Robin's consulting, let's say she's going to wait, she's going to allow that she provides the service first and then gets paid for that service after service delivery. So it might be that she provides the service and then 10 days later or 30 days later she gets paid for that service. And so then there might be a delay, and that might mean that she provides the service at the end of July 31st, but gets paid in August. So it's going to look like July didn't do so well, but in fact she did earn that money and it's coming in August. So that's kind of important to think about too. And that you'll get a sense of what I'm talking about when I show you the spreadsheet as an example. So what is it going to look like? It's going to look at the cost of each sale. What is the cost of each sale or cost of goods sold? And we're going to talk about what is a good cost of goods sold in just a moment. And financial experts use this number specifically so they can estimate how much you keep from each sale. So part of the reason that this is so important is that the cost of a good sold, as I was trying to say, your pizza might cost you $15 for the person who's buying it. But what did it cost the person to make it? And that's a good question. And I talked about all those different things that might be included in the cost. And that number is going to help businesses decide how much profit you're going to make based on the price that you sell it for. So here's the example. So here we've got Joe's Pizza Shop, and you've got the cost of goods sold, and it's basically $15 for the pizza, and then you're going to have the cost included. Remember, the pizza box, the cutter, all the ingredients for the pizza. It's the person who the employee costs to get it over there is going to be $5. And so you're making $10 per pizza as profit. And that $10 means that you've made 2/3 profit off of a $15 pizza, which is a really good margin when we're talking about margins. So your cost of sale is 33.33% of your budget, in a sense. Any questions about that? Does this make sense? Okay, I'm going to keep going. And so what does it look like? Next, you're documenting other costs. You're going to, specifically, I've been talking about rent. I've been talking about the labor. I've been talking about utilities. But you have these office expenses like the computer, the printer paper, the printer cartridges. You've got expenses. The biggest one nowadays is marketing. It used to be marketing was a small thing, but nowadays marketing is considered a lot of times about 1/3 of your budget, in particular because in order to expand your business, there has to be marketing provided. Marketing can be hard materials like the printed materials we were just talking about. Maybe you have pens with your logo on it. Maybe you have Post-it notes with your logo on it. Maybe you have brochures with your information in it. Maybe you have in marketing materials costs to go on a website and Google ads, Facebook ads, those types of things. All of those are costs, marketing costs. And do these change on a monthly basis? It might be that you allot $100 one month for marketing on Facebook ads, and the next month you do nothing. And then the following month you do 200. It's up to you. You might want to do a standardized amount per month, but those are the costs. What about loans? If you've gotten it or are anticipating a loan, you have to document these proceeds of the loan as income. It is money coming to you. And you want to think about loan payments and making sure that they're listed as an expense because they are going to be going out of your business every month to pay back that loan. And they should also be considered part of the cost. If you're purchasing a pizza business and you're needing to buy that oven I talked about, that oven might have cost you $20,000 and you're paying, let's say $250 a month for the next 6 years. So $250 a month, if you're paying $250 a month for the next 6 years, that $250 a month needs to be considered one of your expenses. It's a standardized expense that you're going to have going out, and it needs to be included in how much is that pizza going to cost me to actually make, because I got to pay that loan back. It needs to be included in what I anticipate money going out. So you want to make sure that you're able to cover your expenses with your revenue. And that means that that pizza right now, let's say, remember we talked, it was $15 and we had our cost of goods to make that pizza was $5. Well, maybe now it's $10 with all the loans and stuff. And so now my margin is only a $5 gain. and I actually have a cost of goods sold as 67% or 66.666%. That could be how it goes. And is there enough money to pay yourself first? I cannot stress this enough, because a lot of people think about the cost of the business and then they forget about themselves. And you are going to have to pay yourself to survive. You have your own food, you have your own personal budget, right? And how much is it going to cost you to live? And how much is it going to cost you to have this business? So it's important to pay yourself first. I know that sounds selfish, but on the other hand, it's important to include that in those costs again. And are there months where you can plan to pay, where you need to plan carefully? As I mentioned, you have in the winter months a pizza business doing really well because of the football season, because people don't want to drive, people want to have more deliveries, things like that. The challenge is the summer, where people have more cookouts and barbecues, etc. So they're purchasing pizzas less often. This was a unique year. I suspect that pizza places did really well in the spring, and specifically because we weren't allowed to go anywhere. So this was a different kind of year, but. And that leads us to our break-even calculation, and our break-even calculation allows us to understand what is our break-even point. And to do that, we have things. If you're starting your own business, you're going to have startup costs, and those will include things. Let's say you are a consultant and you want to sell services. You think, well, there aren't really costs, but yes, there are. You have to purchase the computer, the printer paper, the printer cartridges, right? So you've got that, your toner, all that stuff. But more importantly, you might have startup costs of your marketing materials. That's considered a startup cost because you've got to get your name out there. So how are you doing that? You might have overhead. That overhead is going to include things like the rent and the utilities. So let's say you have your business out of your house. Is there a percentage of your house that you can include as part of your overhead costs? And the answer is yes. But how are you going about that? It's usually done through taxes. And so your overhead costs are things like a percentage of a room that you use as your office. And so that's what you want to consider it. And then if we're looking at the unit is the product or service that you're actually going to sell. And so you're looking at your unit business percentage in decimals. And basically, you have a gross profit, which is the total money that you're bringing in after your expenses, and then you have the net profit, which is money you make after that unit purchase and after your expenses. And so you're going to have your startup costs times your unit business percentage, and then you're going to have that divided by your gross profit, which then equals your break even. There are variable costs no matter what. One day you might purchase marketing and it's $100. For that same marketing the next month, it might be $150. 1 month you might have a utility bill of $200 a month. The following month it might be $233.45 for that month. So there will always be variable costs, but the break even is to try and anticipate. If you looked at the last 12 months of your utility bill for your home, what are those 12 months look like, and span it out, average it out over those 12 months so you have an anticipation. On the other hand, knowing when you're going to have money going out, let's say the winter bill is really high or the summer bill for air conditioning is really high for utilities, you might have a different break-even point for the sale of your item at that point. But you want to anticipate for the year and come up with a cost for the item for a year, not for the one time. So the unit percentage is going to be that overhead cost each unit is responsible for covering. And here's an example so that this makes sense. You're going to have startup costs, and that might be a website. To get your website up, you might pay $5,000 for a page, or $5,000 for the whole website, office equipment, and then there's a whole list of items, and you're going to get there's a spreadsheet that will have this information on it, so you'll be able to see more of the items that are included here. But these are your startup costs. $50,000 in startup costs. You have $50,000 in staff salaries and overhead, and so your total costs are going to be $100,000. But then your gross profit is $10 per unit. So if you're doing that, you need your startup costs plus your overhead costs, which are going to be $100,000. And then you need to figure out how many of these $10 items are you going to need to make $100,000. So you're going to have a $10 item that's going to need 10,000 of them. And these are wall calendars. So I'm going to make 10,000 of these $10 calendars to have 100,000 break even. So I have to sell 10,000 of these $10 calendars in order to make 100,000. Hope that makes sense. Some of the things that you want to think about in a simplified form, instead of saying, breaking out all those bills, just saying, here's my total bills for January, here are my total bills, here's my total amount for staff, my total material costs, my marketing costs. These are going to be my expenses for the month. January, February, March, April, May, June, all that stuff. Then you're going to come up with each product having its item, its cost. And basically our intent is to make sure that at the very least, our break even means that our expenses and our revenue are going to be equivalent. Meaning if I'm going to spend $400, then I'm going to make $400 that same month. That's our break even. If we can make more though in the revenue via an added service or an added product, then we will be gaining and making profit. And that's ultimately what we're trying to do. So, whoops, blank one. Sorry about that, guys. And so here's an example of a cash flow statement, again, showing operating cash flow, investing cash flow, financing cash flow, and then whether it increases or decreases. And that's pretty much what it shows. So what's next? Well, we're definitely here to help. And I don't know if this made sense. I sure hope it did. But I encourage you to make an appointment for one-on-one coaching with Tara or Laura or anyone else. And I am now open for questions. So Laura, do you see any questions? Tara, do you see any questions that I can answer?
You did miss a question a while ago. I'm sorry, Anita. It was before you were going through the break-even analysis, and it says, do you add the entire amount or do you just put the 250 times 12? So I don't know if you know what slide that's regarding, or Tamita, if you want to clarify again.
Can we unmute her and open that so that she can talk to me and ask me?
Yeah, Tamita, I'm going to try to unmute you. Let's see.
I'm not sure I understood the question, so just let me know.
Can you hear me?
Mm-hmm.
Okay. How you doing, ladies?
Good.
Well, thank you. And I'm sorry, your name again?
Tamita.
Thank
or
you.
TT.
TT.
Yes.
I like it. Okay, what can I help you with?
What I was asking was because, like, you said like the entire cost of the stove would have been like, I think you said 60,000. So just say if you're doing, you're doing your taxes, do I put in the 250 times the 12 because how much I paid for that year, or am I putting in the total amount?
When you
if I'm
say
right or wrong.
putting in where and putting in, I
In my
understand what you're
in my
asking.
taxes, in my taxes.
Well, so no, so let's back up. First of all, I am not an accountant. I'm going to specify that. Second of all, this is not legal advice I'm going to provide. And third, I will say this, that if I think I was talking about, let's say I bought the stove for 20,000 and I am going to pay it down, that loan to purchase that piece of equipment over 6 years at $250 a month for 6 years. It's like you buy a car, right? You don't
Right.
pay for the whole car at once. You're buying it via a loan and you're paying on the loan every month. And so that's what I'm paying, $250 a month. So when I'm thinking of my cash flow statement, I'm thinking about what's my current income and what are my expenses.
Okay.
The 250 a month is considered an expense. For tax purposes, you are going to say that you took on this loan, and then it's going to include what did you pay on the loan and what interest did you pay on the loan. So it's going to include both the principal amount and the interest that you're paying on the loan for your tax purposes.
Got you. Okay.
Is that helpful?
Oh yeah. Yeah.
Yeah.
Thank you.
Sure. Do we have any other questions?
We don't have any right now. Thanks, Tamita. And I'll just say, I'll add one thing. Thank you so much, Laura, for this. I think one thing that's really critical for a lot of our businesses is seasonality, because so many of us are, based in the tourism economy, or we'll have clients that come at certain times, but not all of the time. So I really like, when we send the documents out, I really like that wall calendar is an example of seasonality, because we know, I think some of you might have been on the business planning webinar, but we know that people, buy calendars October, November, December, maybe January, maybe February.
Yeah.
And that's when you're making all of your money, but your inputs are going to be earlier in the year, unless you're, selling to stores earlier in the year to get the product out or something like that. But I think it's just really important to keep in mind. And one reason why doing this cash flow, looking at the information month to month to month to month, to make sure that you're planning ahead for how many sales you're going to have to make in a certain time to make up for your expenses if those things aren't lining up.
Well, and to that end, one of the things that I think about is not just your income and expenses. One of the things that I look at, just to go back to Robin's consulting, is I say, how many calls is it going to require me to make in order for me to get one sale? How many calls and interactions is it going to take? And so I have to figure out, let's say if I'm going to look at the month of January, I need to make 100 phone calls to people to set up 10 meetings to make one sale. And then what is that sale total going to be? And I have to anticipate what is that sale total going to be. And then, so it's more than just, it's like taking that amount that I want to earn. So think about that number that I asked you to make in the very beginning, that the amount that you wanted to earn in the very beginning. And now start to think about all the expenses that you might have to take out, and how much more then do you need to make that number? Or was that did some of you include that number? So in other words, if I wanted to make 100,000 in a year, but I'm going to have 40,000 in expenses, then I'm only going to take home 60,000. And if I'm taking home 60,000, is that including taxes or not including taxes? And so based on that, I have to take that number of 100,000. How many clients is it going to take for me to get to 100,000? And how many calls is it going to take me to get that first client? And how many pizzas is it going to take for me to get to that total, minus all of my expenses? So I think that's really ultimately what you're trying to capture, right, Tara? Yeah. Do we have any other questions? I noticed that there were some chat thingies happening?
Just some administrative things. So there was a
Great.
question about if this is being recorded. It is. So Dwayne let everyone know that we will send this out after, send the recording out after, and a request for coaching, which is great. So you will be getting a follow-up email from Laura Ford, who is our client intake specialist, with all of the documents from today, an evaluation form, so you can let us know what you thought. And what you'd like to see for future training is really important. And you can also request coaching from her from that follow-up email.
Great. Great. Well, thank you very much. I really appreciated it and enjoyed having this opportunity to talk to folks about the most exciting topic of money and cash flow.
This is great. It might not be as fun as some of our marketing and other things that are, you know, how do you use Instagram? But it's, like Laura said, it's the lifeblood of your business. And so it's really important.
I want everybody to be healthy, no heart attacks.
And Laura, you did a great job. You're doing this topic a great injustice if you think you can cover it in an hour anyway.
Yes.
So sign up for the coaching, and it will be much more beneficial. This supplements the coaching, so keep that in mind.
Yeah. Yeah.
Okay, thanks. Thanks, everyone. Have a great afternoon, and we will be in touch.
Thank you.
Bye, everybody.
Bye.